different types of transactions we have seen, cash and credit transaction. A systematic way of accounting all these transactions, classify them into three: personal, real, and nominal. What is personal account? Where persons or person representatives are involved. As per that one, we call it the principle, otherwise called golden rule: debit the receiver, credit the giver. Most of this account will come under debtors and creditors, payables and receivables. Another set of account is called real account, which you can touch and feel and experience. This is called a real account. Real, when I'm buying assets which are tangible, land, building, furniture. As per the golden accounting rule, debit what comes in, credit what goes out. I'll give the examples later. Nominal, namesake, basically. Now I'll say salary. We cannot see salary. I can see the cash I'm paying. That is a real. Salary is an expense. So all the incomes and expenses are called nominal, mostly. The principle of golden principle is debit all expenses and losses, credit all incomes and gain. Now coming back to personal account. When I say I am selling goods to X person, X is my customer, personal. Debit X. Now, second aspect of that particular transaction is I'm giving the goods. Goods means something tangible. Credit what goes out. So X account will be debited. The what is going out, my sales, is credited. Now, when you say real, I am paying cash in order to buy office furniture. Cash is real. Office furniture is also real. Debit what goes out. Sorry, debit what comes in. Credit what goes out. What is going out? Cash is going out and furniture is coming into the business. So furniture account will be debited. Cash account will be credited. Nominal. I am paying salary. Salary is a nominal expense. So we debit it. Cash is real. It is going out. So credit. So it can, possibility is the type of account, personal, real, and nominal. One part is real and one part is nominal, or one part is personal, the other part is nominal, possibility. So as per the accounting principle, if it falls under personal, debit the receiver, credit the giver. If falls under real, debit what comes in, credit what goes out. If it falls under nominal, debit all expenses and losses, credit all incomes and gains. This is as per the accounting knowledge, that is the systematic way of looking at it. Now we can a little more simplified. We have already seen we have four purposes for which all the transactions are taking place: income, expenses, assets, and liabilities. Now, when income comes, mean income is one by one, it is coming in, we call that is credited. When incomes decreases, debited. When I'm purchasing the assets, it is debited. When I'm selling the asset is credited. When I'm making the payment for expenses, I debit it. When I'm reducing my expenses, credit it. When I'm taking a loan, I credit it. When I repay the loan, debit it. When I'm taking money as a capital, credit it. When I'm withdrawing money from the capital, it is debited. So this way also you can look at it. Asset increase means debit, decrease means credit. For the accounting purpose, and I told you about special transactions, regular recurring transactions, and repeated transaction. For basic of understanding, it is classified into books of primary entry: cash book, where we record all cash transaction, whatever cash received, whatever cash given. Sales book, when any sales is happening, on credit basis, we will write it down. Okay, XYZ has taken this much goods. Any credit purchases happening, we put it in the purchase book, where the supplier's name will be written. In the sales book, customer's name; purchase book, supplier's name. Now, sales return. Somebody has taken in goods on credit and they are returning the goods because of faulty or any other reason. So it will go to sales return book. Same way, if I am purchasing from some supplier and I am returning to the supplier, then it goes to purchase return book. Now, it is not included in any five of this, Any other transaction takes place, that will be recorded in journal book. So we have seen basically the purpose of it, types of account. Basically, we can looking at from real, nominal, and personal, or income, expense, assets, and liability, primary books, cash book, sales book, purchase return, sales return, and general ledger or journal.